Okay, so the book contains different theoretical topics, just these are all about the mathematical concepts. So today we have to talk about the compounding frequencies for interest rates, because it will be relevant for us during the next week and after that. So you can see here that there is appendix 1, B, C, and until L. And these are really good because they are summarizing everything within 3 pages. So all the relevant things, even about CDOs or CDSs, they are summarized here. So it's really good if you would like to have a short summary about something. Okay, in today it's quite simple because I think this is obvious for you. So future value and present value calculation. This is just necessary for us because later on we will always use future values and also present values, and that's why we have to introduce it somewhere. But practically, yeah, time value. So if future value, we have to multiply it with the interest rate, and we have to account the value of t. And in the present value, we are not multiplying, we are dividing with the time value. So I think that's all here what is relevant for us. But during the semester, we are not using discrete interests or discrete present values and future values. We will always use continuous. Because to build up functions for modeling purposes, continuous approach is way easier for us because we don't have to deal with dots. And it's always a funny thing because model building is much easier at continuous level, but trade is always at discrete level. So you should never forget about this thing because it can create additional risk for any kind of trading strategy. But what is the difference here? We have to use the Euler number, so the 2 on 2.72 something, which is really useful because if you are using the Euler number, then we can jump back and forth between logarithm, and that's why it's good for us. And also, now if we can see, so if you are checking any kind of equations and it's you can find E and R something, it will be the future value of some asset. So that's why it's also quite elegant, because we can see that, yeah, just let's take the interest rates, let's take the time, and after that multiply them, and let's put it on the power of the Euler, and after that we can calculate the future value. So we don't need any kind of mathematical thing is what we have to do here. So yeah, so this is what we were able to learn here today.